Good morning, traders. It seems Ryan has, oh, there we go. Ryan just joined the fun. So I'm going to let him take over. Ryan, if you're there. Hello. Yep, I can hear you. So welcome to everybody. Welcome, Ryan. How are you doing?
Can you hear me all right?
I hear you. Yep.
Happy days. Good morning, everyone. Sorry about that. I had to clear some cookies last night and it just wouldn't let me log in. So now I'm back in. Let's get that up. Let's get that up. Who we got today? Oh, we've got Steve again. Must be Wednesday for Steve. Morning, Kay, Stel, Steve.
Morning. How are you?
Yeah, I'm all good. How are you doing?
Very well, thank you.
Good, good. Right, let's get stuck in.
Good morning, ladies.
Oh, there he is. Morning, Steve.
Good morning.
Having fun?
Having fun. Yesterday night wasn't much fun.
Well, yeah, it was not a lot of fun all round, I don't think. You'll have to excuse me. I'm going to keep my squawk on as we do this. Obviously, lots going on in markets, lots of comments coming out, particularly from Japan. So I've got some positions on that I'm monitoring. So I might be trading as well as running the show. So, right, let's get stuck into it. Oh, where do we start? Where do we start? Obviously, the big deal yesterday was the CPI data. Now, let's look at that first. We've got to jump in CPI higher than expected. The 8.1 expected there came in at 8.3 versus 8.5 last month. So first things first, in CPI, it confirmed a further dip from the highs that we've seen, 9%. So it beat expectations there. Now, however, the core, as we were talking about, that strode back up to 6.3%, beating expectations. Now, as we pointed out yesterday, that had been coming down since the high of 6.5% back in, I think it was the April print. So looking at that altogether, you wouldn't have thought we'd get the move we did yesterday. And I certainly didn't think we'd get such a move as we saw there. This is the market's gone completely bonkers over this. Now, it could have been that the market was positioning short into this, again, pushing the Fed's buttons with a little bit of help from obviously the Japan side, talking stronger about intervention and things like that. But it was a complete murder in the markets, really. You know, dollar yen jumping up 300 pips. Inflation hasn't hit new highs. It certainly, looks a bit like it might be going a bit up and down over the current months. As I said, it's come off the highs. We pointed that out yesterday in the chart I showed, where it seemed that the core had actually been leading perhaps the headline number in dipping off the highs. But there was a possibility that the core could catch up. That may be what we're seeing in the numbers there. But the reaction, as I say, was pretty big. You can't take that into account any which way. I don't think we've had a bigger data move on that for years. Do you reckon, Kay?
Yeah, indeed. I mean, everything got absolutely smacked. Dollar hovered. We're just talking about a possible change of sentiment that we saw over the past over the sessions prior. But then I think the same accounts went in pretty heavy to reload what they had. Anyway, the move on the announcement was pretty crazy, and that's a really big move on just one data point.
Yeah. It just shows you that the market was very one way, right? And we were talking about that.
Everybody was
expecting. Yeah, exactly.
Expecting and hoping, and positioned,
yes.
and positioned in the side of the hope, as you say.
Yeah.
Yeah. I mean, I want to just show you something. Let me just let me call it up again. Apologies. I'm a bit. I wouldn't say flustered, but I'm a bit all over the place today, just trying to keep an eye on the bits and pieces. Let me show you this. So I looked at this pretty much straight after the data, and this is the one of the interest rate probabilities. The metrics run gives it an idea of which way the market's looking at from the rates point of view, where they see rates. This was showing 81% for a 75 pip hike next week, and it was showing the balance 19% for a 50 basis point hike next week. This was immediately after the data, and that had dropped from 85% sometime previously to that for 75 pip. Then when I actually joked on Twitter, I'll wait for it. We'll get the 100 BP calls coming out soon. And then I looked at it 5 minutes later, and it had done a complete switch around. It had changed to 81% for 75, 19% for 100, which I think is absolutely bonkers. I'm happy to state here now, I'll eat my hat if the Fed do 100 basis points over this data next week. But the market again is, pushing the envelope here. I think personally, the reaction we're seeing is a complete overreaction. I think the Fed will come out and look out for old mate Timmy Leaks. He came out yesterday, Nick Timmerus at the Wall Street Journal, saying that a 75 basis point hike is pretty much nailed on. He's been penned as the new Fed insider, following some of you may remember John Hilsenrath, who used to supposedly have the ear of Bernanke back in the day. He may come out with something between now and the FOMC to either push back against these 100 basis point calls or even confirm them. So that's a bit of a risk to look out for over the days ahead if he is a bit of an insider and if he gets a nod from the powers that be. But it's twofold. These expectations are pretty much doing the Fed's job for them, because it will send shocks through the market. It will have people on the ground thinking, crap, if rates are really going to go that high, perhaps we need to cut back. Zero Hedge was out with a piece yesterday, taking, I can't remember, some small economic data point that showed that 65% of small businesses in the UK were putting hiring on hold. So these sort of rumours and this sort of market pricing, if the Fed allow them to continue, will do a lot of their job for them in terms of getting the firms and businesses looking to, maybe reduce spending, reduce hiring, and, lowering that demand that the Fed wants to try and knock back. But anyway, let's carry on with what we're talking about on the data front. Let's get rid of that. So a big, huge move there in dollar yen. I don't think, as I say, that it justifies the data. Certainly not 300 pips. Pretty much unheard of. But then obviously we've had every BOJ and finance minister you could throw a stick at coming out. I won't say every BOJ member, but the key ones. The first rumor overnight was that the Bank of Japan had done a phone around of banks checking rates. If you've been following the show for a long while, both myself and Kay and particularly in the chat room have been saying the various levels of rhetoric that get stepped up. We've gone back into speculative moves, one-sided moves. Now we've had rumors of a phone around. This is probably one of the last steps before they actually intervene. No one has actually confirmed it. No one at the BOJ has confirmed it. Finance Minister Suzuki refrained from confirming that the Bank of Japan had done a phone around. So at the moment, it's just a rumor. It's probably likely, given the source of this, where it came from, the Nikkei and some others this morning. But we wait to get further confirmation on that. The next step would be if we get full-on confirmation that they're actually doing a phone around from more, let's call them more reliable sources per se. But we've had Suzuki, Matsuno, Kanda, all coming out this morning with various comments, pretty much a repeat of everything, talking about speculative moves, that sort of thing. But what's been interesting is that it looked like Bank of Japan's Kuroda got doorstepped, questioned this morning or their evening. And the comment that was posted on the wires was that he refrained from commenting on the week yen. That instantly kicked dollar yen up some 40-50 pips. It was around about 142.90s, kicked it all the way up to 143.40s. This is the volatility we're in at the moment with these headlines. You've got to be very careful. If you're trading this, pick your levels. I wouldn't go too wide on your stops or anything like that. You need to be very careful of the volatility. Single comments can move this 50, 60 pips, maybe even more. So what we've got here is a situation. A lot of people got run over yesterday. I got run over yesterday trying to shorts up in the 143s. Got bowled out purely because of the volatility in the moves there. So it is a dangerous time to fade some of these moves. We've got big swings going on. So what I say is that, just to repeat, be very, very careful what you're doing here. Volatility at the moment, the 1 month at the money vol's running at 14.33%. So we've seen a bit of a jump up there. If you're going to trade it, pick your edges. I mean, I got in a short last night. I was literally in bed, 144.80. I missed the move to 95. I wanted to have a little bit on overnight against that 145 level. I think the range to look at from here is this 141.50, 145. We've got intermediate points, as you can see on my chart there. I'm not going to be really interested in anything in between any other smaller levels. Kay, how do you play this in such volatility?
Yeah, that's exactly how you said it. Wait for the market to come to you if you want to try anything. Without knowing what was going to happen or any comments, I did put a bid around 143.5 in which got filled overnight while I was sleeping as well. But then looking at the comments and the urgency they were talking with, I took it off. I'm just waiting now and see whether they come in. But I think now there's a few things now to say about the 145, right? Despite whatever they can say about volatility, somewhere BOJ kept their word in checking rates when the moves are more than 200 or 300 pips, which they did. I'm pretty convinced they did indeed check rates. They created a double top now at 145. I think despite watching volatility, I think the 145 now is a line for them, especially if it would be with yen weakening and where the rest of the currencies is not weakening that much. And we have to look at the yields, especially the 10-year dollar yield. We have to look at what the Bank of Japan is doing in the bond market. Last night they increased their volumes of JGB buying because the 10-year was banging against the 0.25% again. So somewhere they're checking rates, but in the meantime they're keeping the YCC firmly in control. They are meeting next week, so we're expecting stuff. I expect yen actually to remain volatile, despite them wanting not to be too volatile. It is going to be volatile because the market is just so nervous, and there's still people who will be plugged into correlations between yields and the yen. Also keeping an eye on what the energy market is doing. But I wouldn't rule out if we go for another try at 145 if US yields don't start to come off before the Bank of Japan meets next week. But yeah, I mean, be patient if you want to trade it. Just be very patient. There's some levels in the 142s. There's a bigger one around 141.5. And then we have the 145 on top, and that's it. Those are 3 levels now to keep a very, very close eye on.
Yeah, and perhaps it's wise to also note that be very careful on a weekend now, because they have intervened in the past early on a Monday morning, their time, which would be Sunday night if you're in the UK. They can tend to use the low liquidity times to get the most impact from if they do decide to intervene. So I think now there's potentially a growing risk every weekend, as long as this continues and we don't see the price, moving down significantly, for intervention to come first thing on a Monday morning. You need to factor that into your trading, because it means potential gap city if they decide to come in you know, market opening on a Sunday night, you know, we're probably talking 3, maybe 400 pip moves, and that's potentially a gap from when the retail platforms open up. So be very careful going into the weekends. Steve, still, if you're still about, what do you make of the intervention risk?
Hey, sorry, I was replying to a client on something. What intervention of what? For what were you talking about? Sorry, I've been off for the last few minutes.
In beaches, not allowing you to use a sunbed for more than half an hour.
Come on, which part? Intervention in the yen or where?
Japan, yeah, the yen.
Japan. I don't know, man. You guys are the experts on this. I haven't traded the yen in ages, so yeah, I know it's funny, Anne, isn't it? I really don't know is the answer. Sorry, I can talk about the CPI if you want and all that, but yen, yeah, I'm not helpful on that, I'm afraid.
No worries. Well, what's your view on the CPI? Was it a ball buster number? Has it changed the Fed, pushed them up to a higher rate bound?
It's definitely going to make them think twice before saying, yes, we're on the right track. I mean, inflation is still dropping. Right, it's still dropping. It's just not dropping by as much as the market expected, and the market was very one way. And I was talking to a couple of friends of mine. We go to the gym together. I've talked about them before. They're ship owners, very, very smart guys, but they're not traders. And they're going, you know, what happened yesterday? You know, why the meltdown? It's only a small miss in the inflation to the high side. And I said, look, you know, it was very positioning seems to have been one way, and also it just gives the Fed less reason to or excuse to say, right, we're on the right track. We might take the foot off the accelerator a little bit. But inflation is still going lower, and we have to remember that as soon as we get to January, February, the rate of inflation is going to drop by itself quite well, you know, in a quite big way, because we're going to be comparing year on year with 2022 January, February, March, which is when everything kicked off. So I wouldn't be surprised if we see inflation year on year fall down to, you know, 2%. I know it sounds crazy, but you know, given the huge jump that we had in the beginning of this year, remember, you know, the rate of when you're comparing year on year, you're comparing to the previous year. So even if we go down to 0%, it means that the previous inflation that we had is now baked in and is there. So yeah, it's not good. You have to see deflation, you know, before you start to celebrate, you know, oh, we're going back to normal. I don't think we're going to see that. But as I said before, I think inflation is going to naturally drop no matter what the Fed does. Obviously, if the Fed's tightening more and more and more, then they're going to drop it a lot faster because they're going to kill demand, which is what they're trying to do. So, you know, for the short term, I think that this is a definitely a risk of continuation event, but I think that it's not, you know, the end of the world. My God, the Fed's going to 6% rates. No, I don't think so. I don't think so yet. We want to wait and see more data points and more employment data points and more GDP and inflation data points. Because we have to remember, the Fed may say, yes, we really want to bring inflation down and we don't care what happens with growth, with the economy, but they really do care. You know, they say that, but if things start crashing, they're going to be right out of the gate saying, yes, okay, we're gonna do something about it. So I maintain my view that nothing's going to happen, nothing major is going to happen unless the S&P hits, you know, 3,400. I think that's where the Fed steps in. For now, I don't see any reason why we should be buying risk assets, and you know, we trade what we have, and this is what we have. Yeah,
I mean, I think slightly differently. I don't think inflation is going to come down meaningfully at all in the next 6 months or longer. I still think, and I've had this thought for a couple of months, that we're not done with inflation yet. You know, we're going to have some easing off. You know, you only got to look at the oil price, but the price of oil needs to be sustained lower before that effect starts washing out. And it doesn't happen. You know, a $10 move in oil today doesn't change inflation next month. You don't see the inflation move from those sort of moves 3-6 months time. So I still think we've got a long way to go. And I still think there's a risk that the Fed are going to be forced to go higher than the expected, 4.25 terminal rate. I think we could possibly see rates, 5, maybe even 6%, if we don't see a turnaround in inflation or
yeah.
Jane
says rents won't come down. That's actually probably true.
Yeah.
Our friend Catherine says fertilizer shipping, it's a mess. Well, shipping, I was talking to 2 shippers today, and they're saying that things are starting to look much better already. Obviously not back to anywhere near being normal, but things are, they are looking better. I mean, they're ship owners, they should know, I think. But we're not out of the woods yet, but I think it's not this extreme situation that we were seeing, a couple of months ago or 3 months ago. So.
Yeah, it's definite easing. Some of the people I follow on Twitter, Uresh, he's big in the shipping. He works in the shipping industry. He says that those sort of supply problems are easing. They're not back to sensible levels, but they're on their way. But then you get the US rail strikes potentially happening Friday. 3 days of those, and the US can grind to a halt, and then we're back in the same boat again. And that's also inflationary. The rents thing is a big thing. That was a huge part of the increase in inflation in the numbers yesterday. They're having a big impact, and they are very laggy. They take quite some time to come through, but it is a big issue there, as Jane says. I've just shown the chart there because there's a question from Austin about can I share now what I mentioned yesterday, news from the community. I'm not sure what exactly you're referring to there. You can always catch up yesterday's show, which probably had everything you need to know ahead of today. But if you want to just pop in the comments what exactly you're looking for, I can answer that. And just showing the chart that I pulled up from yesterday, showing that move in the core number coming down, from a high before CPI hit its high. We're probably yet to see the core reflect that CPI high and move up, which might have been what we got a bit of yesterday. But yeah, it's going to make it very, very spicy going into the FOMC next week. If the Fed do knock back 100 pip hike, you're going to see another big adjustment in rate expectations and the market moves there. So just to tack on some of the other lines, which and bits and pieces that have come out, just talking about those Fed expectations, sorry, quickly. Nomura has been one of the first banks to come out and call that the Fed will go 100 pips next week. They're often one of the ones who like to get their comments out first. Then it becomes a big competition. Everyone waits to see what gold is and JP Morgan does. I don't think we've had anything from those guys yet, have we? Does any of you know?
No, the only one I saw was CIBC not ruling out 100 BPs either. I haven't seen any comments from the big heroes.
No, so probably be looking for those to drop today. Now, elsewhere, we've got obviously still the Russian situation going on. Z is meeting Putin today. Ahead of that, there are some rumors out in the US. Sorry?
Tomorrow, I think. Is it today?
It was today.
I saw somewhere yesterday it would be on the 15th.
Okay, maybe that was, I can't remember. Anyway, whatever day it is, today or tomorrow, the US has come out with, or there's some rumors out the US that they're possibly going to put some sanctions on China to deter any Taiwan action. Take that as you will. That sounds like they're dropping something ahead of this meeting. So take that into consideration. But apart from that, no other real headlines that's worth mentioning amid all these moves. Kay, you got anything you want to throw in before we get into the charts properly?
No, just von der Leyen spending 140 billion euros in the next campaign apparently this morning. So that's about it.
Cool. Okay. Well, let's crack into it. Right. So where to begin? the real exercise I did yesterday was go to a bit of a wider view and see what levels were in play. You know, Kay's pulled these levels up as well. We know the 145 in dollar yen was a big one. We know 99 in euro dollar is a big one. Aussie dollar 67s was another one. So there's been plenty of levels around the FX space that I've been looking at for potential stretch points, you know, to see if the market is going to push the envelope. These are the sort of levels that are going to need to be taken on. So looking at euro dollar, you know, we got into the 99s, but, you know, really not even down into the low area there. So buyers are still coming in. They've found themselves, that's where they want to pick it up into the 99.50s, 60s. We're back above 101. From here, it could be a bit binary. You know, we've been speaking the last few days when we got the move from 99s up to the 102s, potentially a change in sentiment, more a dip buy than a rally sell. This might have shaken the tree a bit. I think what we do around parity right now is going to be key. If we hold above, there's chances are we're going to push back up towards those highs. If we get below and hold below, then we could be on another run for 99 below. I'm in this situation where I'm going to keep it simple, really going to keep it simple, stick to my levels, pick my edges, and take it from there. Aussie dollar's another one looked at last night, down into 67s. We've gone 67.05, I think is the low. Yep, 05 is the low. So matching pretty much that low we saw last week. These are sort of levels you want to look at. Round in the middle here, I'm not that keen. There are some intermediate areas, 67, 70, 80 here. If we do bounce up, we've got minor resistance coming in 67.50s. Otherwise, we're looking back at the highs where we've seen this high into the 69s. Maybe possibly here 68.20s might be a place where you pause at if we have a move. But it's all about really, can these moves continue? And I know Kay's mentioned this in the chat room. If we do get intervention, how will that play out in the other pairs? You know, even though dollar yen's, you know, come off a good couple hundred pips odd, we're not seeing a lift up in these pairs versus the dollar. It's not a broad dollar sell-off. It's more yen buying. And that's what's dragged the majors down with it. You know, as we just looked at yields, particularly US yields, even across Europe, still remain up, still remain quite high. So for the dollar side of things, you get to know which way the wind's blowing. The US yield staying up should be dollar positive, or more dollars positive. But I think this is more of a yen move we're seeing based on everything going on. Kay, what do you make of it all? If they are going to intervene, are they going to chop and change those interventions around the other pairs?
It depends. I've explained it here, and I've put it in our chat room what my possible scenarios were for interventions. They can go sit on top. They can hit the market. The way they talk, it would appear that if we do such violent moves again, they would come in and hit the market. But we are still not sure. They could just go on the next move up to 145 and sit on top. But I think whatever happens, of course, you got independent dollar moves and currency moves elsewhere. But whatever happens, if they need to come in because the dollar is too strong, let's put it that way, they might create a wave move in other dollar pairs where the dollar, if you can't buy dollar yen where you have to buy dollars, you will buy perhaps less dollar yen but buy more dollars versus something else. It's one of the possibilities that I'm taking into account, but it's not the only one. Yeah, and I just would like to react because I saw some people on Twitter talking about intervention and amounts, and then there was like one bank saying that they could do $5 billion. $5 billion is not a lot, and I can tell you from experience that they would do more than $5 billion. And when I say more, it's much more. I used to work for an agent bank. in the days, and trust me that it could be more, much more. So I wouldn't hang my hat on to anyone trying to speculate about a possible amount that they could use for interventions.
Yeah, agree. I think it was. I'll just show it up there. It was ING who made that call, and our mate who I follow, who knows his onions as well. Anything regarding Japan, Western Nakamura. He had a laugh at that as well.
It's likely that the guy in ING is a youngster who hasn't had experience from the early years 2000 and stuff. Back then, when there were orders in the market to buy or go sit on the bid at 105, it was 500 million a lot, and we were like anywhere between 8 and 11 agent banks. So that means one round was already $5 million. So I think the guy at ING wasn't in the market then.
Yeah, I liked his final comment there on all that. It's like taking chopsticks to a gunfight. I thought that's very, very apt there. Right, is there anything you want to look at, Kay, on the?
Well, actually, to be fair with you, not a lot. The only one let me just share a couple, okay? Because I think there's some currencies which could be more vulnerable than others. Let me just start to share. I didn't really want to share this one. I was just looking at it. But okay, let's take euro yen, because I was looking at it because of intervention risk. Really, we had this uptrend channel, went already a couple of times above, but the 144.40 is still a bit of a crossroad. We are well below again. I still would look at this level as being relatively important in the short term, at least. And then on the other side, I'm like looking around 142.35 prior top, and we are like still 100 points away. So yeah, I was just looking at this one. No, there was one actually, one which I'm really interested in, this, and that's the Kiwi. It's been weak since RBNZ started to tell us that they might start to be done with rate hikes at the end of the year. This Kiwi is acting weak. I'm quite interested to see what's going to happen over the course of the day here. We have this prior bottom at 60 the figure. We're just around there right now. I'd say allow for a move back up to 60.60. If that starts to go, then I might be looking at the wrong market here. But it does look a bit weak to me. So I say pay attention. It is possible that this Kiwi is doing another big figure lower if the dollar keeps its bid tone. Of course, we have to look at the dollar yields because it's the biggest market. But if you look at the differentials, yesterday the CPIs caused a big move back down in the European versus US differentials. But we are in the short. This is short term, right? Don't hang your hat onto this wedge. But it's a little supportive here around this minus 240 BPs to minus 242 is a differential. So it's negative. It's euro minus dollars. Yeah. So we have to pay a little attention here. And it seems that the stabilization is already enough to stabilize euro as well. The other one here is the sterling, the 5-year, which works better. I'm not sure it works a lot better than any others, but I know more people are watching it. So that's the thing. If you want to trade markets, you better trade something that people are watching, whether they are right or wrong. It's where you get the most interest and the most interested eyes to watch something. So if you would pull up the 10, let's say here, the 10-year versus the 10-year, it's something that some investors may watch in the UK, but if the whole market is watching the 5-year, if you trade on the back of it, you better trade on the back of the 5-year, because that's where the most interest will be. Just wanted to say that, and that works for all markets really. So this one, yes, it came off as well, but it stabilizes as well, and we see, because all yields are rocketing. If you look at around the globe, UK 10-year gilt is at the highs. It was back at the highs yesterday. Came off just a tad. I think due to that people trading the divergence again, or the differentials again, but all yields everywhere are shooting higher. So that means that some of those pairs are going to be much more range driven than anything else. So I agree with what Ryan was saying earlier. Those moves look to be slightly overdone, but I mean, my overall view remains for a bit higher dollar, speculative going into the next FOMC. By the way, I agree on the 75 BPs. I think it's I think the Fed is still on their path, and it's not because we've got like this little surprise on yesterday's CPI. By the way, it's still coming off a little bit, that they are going to change anything to their rate path. Khaled, here, that's the euro dollar, right? So we have this low around the 99 area, 93.75, and then this trend line coming in from 2022. It's coming off a little bit. It's around 101.70 now, but take all of this with it, the up to 101.80, 85, 90 perhaps, and then I'm even watching this zone here, 101.80, 102.25. It's a traffic zone earlier, and it's been a zone from where we had like deeper moves starting as well. So I'm going to be interested in this if ever we make it back up here. But again, I mean, in the long term, nothing's changing for me. 99 is still where the battle for parity will be won or lost. We had 2 tries below, and it's bouncing, and we have to acknowledge that it's bouncing. So, and this level is only getting stronger by the day, in my opinion. But we are going to need a close below 99, which we did not have so far. We need a close below 99, or at least to stay below for a longer time to say with certainty that the battle for parity is lost. Yeah, and then people are talking about 97. I see some interest here, which is a bottom from where the rocket ship took off earlier, and back in 2002, 2003, it were tops around here as well. So to me, the next really big level would be 96 if it would break 99. The overall, the longer term trend is still down, but it's such a wide one that I'm not really thinking about what else could happen if 99 breaks. I'm finding it a bit far to start to talk about the all-time lows again. But then it's a market. Never say never. And you know what? We can look at all those crosses, and as I said, for the time being, I'm a little because I think the winter in Europe will still be pretty tough. There is still a case for being short euro crosses, but I'm finding this Ukraine situation a bit bizarre, to say the least. We don't know what's going to happen with the Xi Putin meetings either. We could see a big counterattack again, or dirtier war with a lot of bombing and everything, or she might, I don't know, surprisingly talk some sense into Putin and shift their attention away to a rather Asia-Russia cooperation kind of thing than really warfare. Right? We don't know. Anything can come out of that meeting, in my opinion. On the cable, This is a bit of a zone here around this 117.60. No, sorry, that's on the daily. But there's a bit going on closer by home here. So if we think this is the move done, and then after CPI, there's a bit of a resistance which I can see here around the 117.70-75 zone. Pay attention to that. Is the 50% of the move higher. We've come down to the 78.6 and bounced from it. It's been called by Amanda, by the way, in our room as well. This low, so pay attention to it. It's pretty important, and I would say 100 points higher lays this 50%, which is also going to be a level of interest. If ever we go higher, 116, around 116.10 should be the next level of interest. And really, for now, I see what Austin means.
Yeah. I'll answer that.
Okay, I just want to share with you one more screen, and that is the only reason why euro dollar is at parity, and that's the only reason. Ferrari unveiled their new SUV, which is, by the way, not an SUV, and the only reason we are at parity in the euro dollar is because the people across the Atlantic, to make it easier for them to calculate the price of European supercars. And I'll leave it there.
How many you ordered?
Am I part of there's 2,000 pre-orders already. I might be 2001, but I need to get my next trade right. All right, back to you, man.
Cheers, mate. Yeah, Austin. Yeah, we got. You
can't.
No, we got a hint of some potential player in the market at a particular time of day, and that's what we had in the chat room. We were able to elaborate on that for our subscribers. This is not information that we're willing to put out in a big public forum, details wise. It's hard enough getting this information as it is without putting it out in the wider market, unless it gets more known or it comes out via other sources, then we can confirm or deny it. But this was a particular entity acting in the market at a certain period of time that was moving prices, and they're one of the ones that took euro dollar up to 102 the other day, which, as you can see, look back on your chart, that's a big move. So yeah, that's what we get. It just means you've got a bit of an idea to keep an eye on the clock at certain times of day. If you start to see certain moves, you have an idea of what they are, whether they're going to continue, whether they're going to fade, whether there's a trading opportunity there to fade those sort of things. But that's as far as I'm going to go on that now. Right, just to check back on a couple of bits, because it is inflation day or inflation week, we should call it. So we obviously had some UK inflation as well, a little bit softer in the CPI year on year, down to 9.9% from 10.1%. The core, though, a bit like the US, ticked up 6.3 versus 6.2 prior. Lots of other metrics there, PPI, RPI, some dips coming in there, but we're still talking elevated levels. The Bank of England aren't going to change their path just because of a 2-pip drop in inflation. Inflation running at 10% still. Crazy numbers. Look down at Sweden. Inflation jumped to 9.8% from 8.5%. Bonkers. Even in India, still running at high levels. Their overall inflation came down a bit. But look at the full fuel and food numbers, still running at huge numbers. It's a global problem. Everyone's trying to fight the same fire in their own way, and that's going to keep the trade open between FX for currency divergence or central bank rate divergence. That's what keeps us in play there. And just quickly, Japan. Okay, we saw that the Tenkan index dropped there to 10 from 13, but Machinery orders, another big gain there. We're seeing a quite significant run of positive Japanese data, and that needs to be monitored, because if the Bank of Japan are going to change their forward guidance, if they are going to look at changing language, they want to see consistency. They're looking at consistent wage gains. That's one of their big ones as well as inflation being consistent around their target point or above. But they're not going to ignore all these data points, keep coming in positive, positive, positive. And that's what we've been seeing for the last couple of months now. So keep an eye on the Japanese data, even if you don't follow it day to day. It's always good to have a little look over and a quick refresh. And one last thing I want to point out, because yesterday may have been tough for some of you guys trading through this. You know, for all my experience, I still got run over yesterday. You know, maybe when I came into the data, I was thinking, you know, maybe 40, 50 pip move. Either side is probably around about enough of a proper reaction for the data. You know, 300 pips in dollar yen, 200 elsewhere is not what was expected. And Simon in our room came in and said, look, after days like yesterday, I find it hard to pull triggers the next day. My mouse finger moves but doesn't complete. And the same can be probably felt by all of you, me included. You know, you come in, you think, right, you judge what's happened. Has it changed at the central bank? Has it changed the Fed? Has it changed the inflation outlook? What's changed in the market? And so I sit here today thinking the moves were outside yesterday. I don't think it changes the Fed, and the market has gone too far with the expectations. And I want to fight that. But my big concern is, how do I fight that when a price is moving 300 pips so quickly, when we've got this volatility? And that's something you've got to be careful on. As I say, you know, you want to fight it, you know, you should be fighting it, but the volatility becomes a big problem. And that's what you've got to take into consideration. You know, step back a bit, pick your levels, stick to the wider ranges. If you don't get a trade there, you don't get a trade there. If you try and trade in the middle of dollar yen right now, you know, as mentioned, Kuroda comes out with a comment and bang, the market's moved 50 pips. You know, that's not in the middle, is not where you want to be. If you want to get in there, fine, do so, but keep your trades tight. You don't want to be offside by 100 pips asking the question, oh, what do I do now? So ease yourself back in. As Andrew says there, you know, difficult to get back in. So ease yourself back in. Don't be in a rush to get back in and get caught out because someone said something or, you know, headlines dropped. Take it easy. Be chilled. Protect your account. That's the rule first and foremost. Anyway, one last thing before we go. I know I wanted to check something with some of you guys and girls. I know you've been, some of you have joined the platform either on a trial or come through the link here, or I've seen your comments that you've signed up for them. Don't forget, please, to use your code FFL20 if you're thinking of signing up to the chat room. That does get you the 20% off our current price for as long as you subscribe. I've seen a couple of you and Stephen, I know you've signed up to the room as well, as you said last week. I think you've gone on a trial for the moment, but I haven't seen that you've used a code, so I don't want you guys paying more than you need to. So if you do come into the room, keep an eye on the code. Make sure you use that code to get you that discount. Every penny counts, doesn't it? Anyway, I feel knackered already. It's only 20 past 11. So good luck for the rest of the day and the rest of the week. Trade safe today. Could be a bit choppy, especially when the US gets in. They want to react to what's happened over in Asia, much as Asia reacted to what happened in the US. Sometimes it can be a bit of a feedback loop. So trade safe, be good. Thanks to all the guys, Kay, Stel, and Steve for his appearance. And we shall see you tomorrow. Have a great day.
Cheers, everybody. Trade safely.